Hi everyone, welcome back to DFTW, a channel to see the world from a unique perspective. Please subscribe to receive notifications for our daily uploads. Today, our focus is on why Africa is now repaying China more than it receives in new loans, why the debt trap narrative is misleading, and how Chinese engagement has materially transformed African economies over the past 2 decades. For years, discussions about Africa and China followed a familiar script. China was lending heavily. African countries were borrowing heavily. And Western headlines often warned that this relationship would end in disaster. Now something important has changed, and it has confused a lot of people. Across much of Africa, governments are now sending more money back to China in loan repayments than they are receiving in new Chinese loans. Some commentators have rushed to frame this as proof that China's Belt and Road Initiative, BRI, was a debt trap all along. But that conclusion reverses the story. What we are seeing today is not the collapse of China-Africa cooperation. It is the normal financial maturation of a 20-year infrastructure investment cycle, combined with a global economic slowdown, tighter lending standards, and Africa's own policy evolution. To understand what is really happening, we need to step back and look at how African-Chinese financial ties developed, why lending slowed, why repayments are rising, and what China's role has actually meant for Africa's economic transformation. First, let us answer one question: how did China change Africa's development model over the past decades? In the early 2000s, most African countries faced a familiar development problem. They needed roads, railways, ports, power plants, and telecom networks, but Western aid and multilateral lending had shifted away from infrastructure. After the debt crises of the 1980s and 1990s, institutions such as the IMF and the World Bank emphasized austerity, governance reform, and poverty reduction, often discouraging large-scale public infrastructure borrowing. The result was a massive infrastructure gap. China stepped into that gap, not as a traditional aid donor, but as a developmental partner focused on physical capacity building. Instead of small grants or policy-conditioned loans, China offered long-term infrastructure financing, engineering and construction capacity, state-backed loans tied to real assets, and faster project execution than most Western alternatives. For African governments, those were transformative. Highways connected landlocked countries to ports. Railways replaced colonial-era lines that hadn't been updated in decades. Power plants expanded electricity access. Mobile networks and fiber-optic cables helped fuel Africa's digital leap. Between the mid-2000s and late 2010s, Chinese lending surged, and Africa experienced its fastest infrastructure build-out since independence. However, that wasn't charity. It was financing. And financing, by definition, eventually gets repaid. Why are repayments rising now, higher than new loans? The key reason is simple. Old loans are maturing, and new loans have slowed. Most Chinese infrastructure loans issued in the 2008 to 2016 period had grace periods of several years followed by repayment-heavy phases. That means countries paid little at first, then increasingly more over time. We are now firmly in that second phase. At the same time, China itself has changed. After years of aggressive overseas lending, Chinese policymakers reassessed risks. Some projects underperformed. Some borrowers faced fiscal stress. Global conditions worsened. China shifted toward risk control and loan restructuring, rather than expansion. It now favors smaller, more targeted financing and focuses on existing exposure, which mirrors what Western lenders did decades earlier after their own debt crises. Still, China didn't pull the plug on Africa, as Western powers had done. It slowed new lending while managing old commitments. Loan contracts don't pause just because new lending declines, however. Even if a country receives no new loans in a given year, it still needs to repay its existing obligations. When repayment schedules peak and new disbursements fall, net financial flows naturally reverse. It does not mean those countries are suddenly worse off than before. It means they are paying for infrastructure they already built. Moreover, China has also restructured and even forgiven some loans to deal with difficulties with some African countries, as the past few years have been economically brutal for developing economies in Africa and other regions. Higher global interest rates, stronger US dollar, local currency depreciation, slower export growth, and the supply chain shocks due to the pandemic, all of them contribute to the worsening situation for most economies, including developed nations and developing countries. It is a global issue, not just in Africa. China itself also faces economic shocks. Most developing countries with high maturing loans are having more difficulties. They earn revenue in local currency but repay debt in dollars, euros, or RMB. When exchange rates weaken, debt service feels heavier, even if the nominal amount hasn't changed. For instance, Argentina's currency lost 90% of its value over the past few years, from 57 pesos per dollar in 2019 to nearly 1,500 in 2026. In the same period, although China's RMB maintained a relatively stronger exchange rate than most African currencies, it was still weaker than the US dollar, despite a recent rebound. So the stronger dollar after the pandemic is a global issue, not just happening in China and Africa. Since 2023, China has issued more RMB loans to some African countries, but most existing loans that require repayment are mostly USD denominated. China has suffered financial losses and setbacks in some African BRI projects, but the reality is more complex than headlines suggest. As mentioned earlier, China financed large-scale African infrastructure over the past 20 years, including railways, roads, ports, and power plants, expecting long-term economic returns as host economies grew. However, a combination of pandemic shocks, weaker growth, currency depreciation, and fiscal stress in several African countries made repayment difficult in some cases. As a result, China has faced loan restructurings, delayed repayments, interest reductions, and in limited cases, partial losses relative to the original loan terms. These losses did not usually come from asset seizures. Instead, Chinese lenders, mainly state banks, have often chosen to extend maturities, grant payment holidays, or renegotiate terms, absorbing financial costs rather than forcing defaults. Chinese construction firms have also seen lower revenues and slimmer profits as new projects slowed and older ones underperformed. Importantly, these setbacks help explain why China has reduced new lending and become more cautious, shifting toward smaller, more commercially viable projects and, in some cases, yuan-denominated loans. They do not support the idea of a deliberate debt trap. Rather, they reflect the normal risks of large-scale infrastructure finance in developing economies and show that China, like other major lenders, has had to adjust after projects did not always deliver expected financial returns. For years, the West has accused China of setting a debt trap for developing countries. The debt trap narrative claims China deliberately lends to trap countries, seize assets, and gain control. That story collapses under scrutiny. First, China is not Africa's biggest creditor. In most African countries, multilateral institutions and private bondholders hold more debt than China. Eurobonds, IMF programs, World Bank loans, and commercial lenders often carry higher interest rates, shorter maturities, and less flexibility in restructuring, so they are more like debt traps than China's BRI projects. Second, China has repeatedly restructured debt, contrary to the idea of asset seizure, by extending maturities, granting payment deferrals, reducing interest rates, and participating in multilateral restructuring frameworks. In many cases, China has been more flexible than private creditors, who often resist restructuring to protect investor returns. If China's goal were asset seizure, restructuring would make no sense. Third, infrastructure creates long-term economic value. A road, railway, or power plant does not disappear once a loan is repaid. They can really make a difference, significantly reduce transport costs, boost productivity across the board, facilitate smoother trade transactions, attract potential investors, and foster robust industrial growth. Embracing these benefits can transform the landscape of business and economy. Even critics of Chinese lending acknowledge that Africa's infrastructure stock is dramatically better today than it was 20 years ago. Some African cities are fancier than American ones. Debt without assets is a problem. Debt with productive assets is how development has always worked. How China actually helped transform Africa is a topic that takes a long time to discuss. It's easy to forget how different Africa looked before the Chinese started investing in the continent. One of the biggest changes China-backed projects brought to Africa has been in transport and logistics. Major railway projects lowered the cost of moving goods over long distances, making it cheaper and faster to get products from farms and factories to markets and ports. New and upgraded highways helped link previously isolated regional markets, allowing trade to flow across borders rather than stopping at national borders. Ports were expanded and modernized, increasing export capacity and reducing bottlenecks that once slowed down trade. Border facilities were also improved, reducing customs delays and boosting cross-border commerce. For landlocked countries, especially, these upgrades were not just helpful, they were game-changing. Better connections meant access to global markets that had previously been expensive or unreliable. Energy has been another critical area of change. Chinese-built power projects, ranging from hydropower and natural gas to solar, significantly expanded electricity supply in many African countries. Reliable power allows factories to operate consistently, lowers costs for businesses that would otherwise rely on diesel generators, and improves everyday living standards. Electricity also supports digital services like mobile payments, online education, and remote work. Without stable energy, economic growth quickly hits a ceiling. Chinese companies also played a major role in building Africa's digital backbone. They helped roll out mobile networks, lay broadband and fiber optic cables, and construct data centers. This infrastructure enabled Africa's rapid leap into mobile banking, e-commerce, and digital services, sectors that now drive growth, financial inclusion, and entrepreneurship across the continent. More important is that industrial parks, special economic zones, and manufacturing hubs supported by Chinese investment created jobs and helped transfer skills and technical know-how to local workers. These zones made it easier for African producers to plug into global supply chains. Not every BRI project indeed succeeded, and some fell short of expectations, but overall, the result was structural economic change rather than long-term dependency. As Africa moves from being a net borrower to a net repayer, the challenges are real. Debt repayments reduce budget flexibility, forcing governments to prioritize spending more carefully. With fewer large loans available, mega infrastructure projects have slowed, at least in the short term. At the same time, governments are becoming more selective, focusing on projects that clearly generate revenue or boost productivity instead of borrowing for its own sake. African governments are not standing still. Many are renegotiating debt terms to better match repayment schedules with economic realities. Tax systems are being modernized to raise more domestic revenue and reduce dependence on foreign borrowing. Governments are also developing local capital markets, issuing debt in local currency to lower exchange rate risk. New borrowing is increasingly tied to projects that can pay for themselves, and financing sources are being diversified. China remains an important partner, but it is no longer the only one. Less access to easy money from a generous friend like China can strengthen African economies over time. It encourages less wasteful spending, better project selection, stronger fiscal discipline, and greater accountability. It is not economic decline, it is a transition toward a more sustainable growth model. The real danger is misunderstanding what's happening. If repayments are treated as failure rather than a normal stage of development, governments may cut productive investment too deeply. If critics frame China as predatory, they ignore Africa's own choices and agency. Africa borrowed to build. Now it is paying, while continuing to use the infrastructure it built. That is how development cycles work. Africa's financial relationship with China is changing, not falling apart. The era of rapid loan expansion is over. What's replacing it is a period of consolidation, repayment, and smarter investment. China remains a partner, but no longer the only one, nor the main source of easy financing. What happens next will depend on policy discipline, economic diversification, export growth, and stronger domestic revenue systems. To sum it up, the infrastructure built over the past 2 decades will shape Africa's future for generations. Roads will still carry goods. Power plants will still generate electricity. Ports will still move exports. Debt gets repaid. Development remains. And that is why the debt trap story misses the point entirely. When the West frames the Belt and Road Initiative as a debt trap, they think China is doing what they did in the past centuries, just as they fabricated the forced labor story in Xinjiang cotton fields, based on the script of their forefathers exploiting millions of enslaved black people in America. When robbers walk on the street, they see other robbers and victims. However, China is not a robber, and Africa is no longer a victim.